Hey, what's up, guys? Jonathan here with Florida Turf Pros. Now, as we end the year and approach December 31st, with that comes tax planning. You should be having a meeting with your accountant sometime about now to discuss, what your tax situation, your tax liability looks like, and if you need to maybe unload a little bit of money to reduce your taxes. That's kind of what I want to talk about in this video. I want to share with you a few tips, things that have helped me in my business to reduce our taxes, while also giving me peace of mind and knowing that we're doing things by the book. So if you're new to the lawn care industry or maybe a few years in business and you're kind of unclear on that stuff, I think this video is really going to help you out. So let's just go ahead and jump into it. The first tip that I would give you about taxes and tax planning, that type of thing, is that you need to have an accountant, okay? This is not a bookkeeper or a friend of a friend or Jackson Hewitt or whatever the heck. You need a bona fide CPA, okay? Somebody who you take your bank statements to, okay? If you are just taking expenses and receipts to a bookkeeper or something at the end of the year and then trying to get tax deductions by trying to remember everything that you spent during the year and just taking those receipts, you are not going to get near the amount of tax deductions that you would if you had a certified accountant who will go through your bank statements, okay? And I'm talking about January, February, every single month, okay? They're going to be looking at that stuff, providing you with income statements and whatever you want. But the main thing I want to get across is that you need to have somebody on your side, okay? You need somebody on your team, and they are going to be worth their weight in gold. And the amount of deductions, there's just so many things that you're not going to know, and there's going to be so many things that you're going to forget about through the course of the year. All those little expenses at Home Depot and all those little lunches out or whatever, all that stuff that you forget about, it's there in your bank statements. As long as you have been using your business card for it, that would be the first tip that I would give you, okay? And the reason I even say that is because I've seen this quite a few times with my friends in the area who get near tax season. They're asking, what do you do about taxes, and if you're doing TurboTax, man, or you're just taking your stuff to a bookkeeper, this tip right here is going to save you thousands in taxes, period, okay? Go to an accountant, take your bank statements. It's going to cost some money if you haven't been doing this throughout the year, but it will save you thousands. If you have a $7,000 or $8,000 tax bill at the end of the year, you're doing something wrong, okay? If you're not making buku bucks, okay? Take your bank statements to an accountant. That's tip one. Okay, tax tip number two, and I've done a video on this before, but most of us, whenever we start our lawn businesses, we're either sole proprietors or single member LLCs, okay? That's just the average. That's not true for everybody, but in general, if I was speaking to the general subscribers out there, then most of us are going to be single member LLCs or sole proprietors. I would encourage you to look at taking the S election if you're an LLC and becoming an S corporation, okay? And I've done a video on this before, but the tax savings are tremendous if you do this correctly. Let me quickly explain, okay? And I'll put a link in the video in the bottom of this description. But if you are a single member LLC, basically with that business structure, you are paying your self-employment taxes on the full amount that you earn for your business, okay? It's the same thing as being a sole proprietor. Single member LLC, in the eyes of the IRS, is the same as a sole proprietor. So that means your self-employment taxes, your Social Security, your Medicare and stuff, all the earnings of the business, if you're a single member LLC or a sole proprietor, all of the earnings of the business have to pay that portion of taxes. They have to pay self-employment and Medicare taxes, okay? What advantage does the S Corp have? The S Corp allows you to pay yourself a fair market wage for what you do. Let's say you pay yourself $20,000 for your position. Well, the only thing that you pay self-employment taxes on is $20,000. All right, that's it. Anything above and beyond that your business earns, you do not pay self-employment tax on. That is huge, guys. If you make $60,000 in profit, and you pay yourself $20,000 of that, well, only $20,000 you have to pay self-employment tax on. The $40,000 above that, no self-employment taxes. That is huge, you guys. It's a little bit more costly to operate an S Corp. That's why you need to be around the $25,000 to $30,000 profit every year to justify doing it. If you're just starting out, it probably doesn't make sense. But at some point, if you've been around for a little bit, I am going to say you should probably be an S Corp by now, and you need to look really, really hard at that just because the tax advantages are huge. Talk to your accountant about that, okay? Okay, the next tip that I would give you regarding taxes is that you need to understand what's best for your business. Is it better to depreciate an asset purchase, or is it better to deduct the full amount of that asset in the calendar year? So under section 179 of the IRS code, it basically says that qualifying asset purchases in the calendar year will reduce your taxable income by that amount for the calendar year. So let's say you need a $25,000 truck next year, like you have to get a new truck. Well, people will buy that truck before December 31st, and that $25,000 truck has reduced your taxable income by $25,000, okay? And that's huge. And the cool thing about 179 is that it holds true even if you finance that asset. So if you finance a truck for $25,000, even if you don't have to spend your own money on it, you finance it for what, $25,000, you can still reduce your taxable income by that amount. The problem, and the reason that I personally do not deduct the full amount of an asset, is because you can put yourself into a vicious cycle year after year, and you can accrue debt very quickly. At some point, you are going to have to pay taxes, and you're going to have to pay the man. If your business is profitable, paying taxes, I'm not going to say it's a good thing, but if you're paying taxes, it means your business is making money and you're on the right track. But if you are financing assets just to not have a tax bill, other than operating your business crooked, that is the quickest way for you to go out of business, okay? I promise, by over leveraging debt just to reduce your taxes, because at some point you can't keep doing that. At some point you are going to have to pay taxes. You just are, all right? You cannot keep leveraging debt to avoid paying taxes, because it will catch up with you. Not to mention, whenever you go to sell that item that you've already written off all of it, you have to pay taxes on that, okay? But if you depreciate an asset over its useful life, if you go to sell that asset, it's much easier to handle the tax consequences of that than it is if you have already fully depreciated that asset. Talk with your accountant, but most of the time, it's going to be best to depreciate the asset over the useful life rather than taking the full deduction, okay? There are exceptions. That's what I'm saying. Talk with your accountant. Okay, the last tip that I would give you regarding taxes is to make sure that your personal account and your business account stay totally separate. And I get it, man. In the beginning, it's totally easy to get those two things mixed up. Maybe your personal checking account is running a little bit low, so you swipe the business card for something. And look, it just creates a lot of mess and unorganization. It creates a lot of work on your end, a lot of work on your accountant's end to have to go through all that stuff. And it doesn't give you a clear picture of what's going on in your business on a month-to-month basis. And furthermore, the advantages of having like a corporation is that it reduces your liability. But if you are mixing your personal and business and basically using your business as like your personal little piggy bank, all your advantage of having limited liability for your corporation goes away, okay? It's called piercing the corporate veil, but without going into that, do not do that, okay? Keep your business, personal. It just makes everything so much easier. And with the timing of this video, I understand that a lot of us, whenever we're just starting out, it's easy to get that messed up. But as we move into 2019, we're just right around the corner. This is the perfect opportunity to get this right, okay? Start 2019 correct, okay? Only swipe your business card for business expenses, and it's really as simple as that, okay? So let's just recap real quick. Look at the S corporation. That's probably going to save you a ton of money in taxes if you've been around in business a few years. You need to know whether it's better to depreciate an asset fully, or if you should depreciate that asset over its useful life. Take your actual bank statements to a certified accountant and not just a bookkeeper. And then finally, just keep your personal and your business expenses completely separate. Guys, those 4 tax tips right there, if you do those things, I promise you're going to save a ton of money in taxes, and you're going to have a clearer picture of what's going on in your business on a day-to-day basis. Good luck, guys. God bless. I'll be in touch.